You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 11122. That's an interesting series of numbers. If you're into numerology and you can figure out what it means, shoot me an email, kl@kerrylutz.com. Well, there just might be a REIT in your future. The thirst, the quench, the unquenchable thirst for yield has led a lot of you to invest in REITs. And the traditional way of investing in a REIT, if you're not familiar with a REIT, real estate investment trust. Okay, it's a trust, so you got trust in it, and that should make you feel a lot better. But the traditional way is you value the cash flow, you value it as a going concern. Person you're about to hear from his real estate background, both in buying and selling real estate and being an appraiser, he's got a different viewpoint on this. His name is Brad Heavey. Brad, you've been at this game for 40 plus years. What I like is your experience is diversified. You've been in different areas of real estate, and you've become a proponent of REITs. And there's good REITs, there's bad REITs, and I guess then again there are what you would call in-between REITs, lackluster REITs, if you will. Equity REITs were the best performing major asset class in 2021, and that could well be because interest rates are so low, the thirst for yield, the ability to invest. Well, I think you get the point. Brad, welcome. Just tell us about your real estate background, please.
Well, it started about 45 years ago. I started selling real estate, residential real estate, and I sold for about 10 years, and I realized, that's not really who I was. So I became a real estate appraiser. And when I became an appraiser, I realized this was probably my forte, what I was really designed to do. As a result of that, I had a niche of appraising million and multi-million dollar homes. And as a result of that, I was approved in San Diego County as an expert witness in Superior Court. And then I became an expert witness in Riverside County, Orange County, and LA County. So for a number of years, I was an expert witness in the valuation of real estate homes, mostly residential property. And that's what I've been doing for the last 35 years.
Mm-hmm. Okay. And this led you into real estate investment trusts. Oh, I should also point out they're required, I believe, by law, by tax law, they have to pay out 90% of their earnings, their income, in the form of dividends. So there's a tax advantage play there. And there's a predictability of cash flow, provided that the underlying assets are solid and produce ongoing and consistent cash flow. Do I have that right?
That's correct. That's 90% of their taxable income.
Correct. Yes.
And it's not a pass-through. So the income, the dividends are taxed as personal income to the dividend receiver.
Right. And you've got the dividend exemption, which basically taxes them as if they were capital gains, pretty much, without getting into all the nuances, because there are nuances. So you like these, you've been investing in them for a while. What do you think the benefits are, as opposed to just going out, buying up properties yourself and renting them out?
Well, actually, I've done that, Kerry, and as a landlord, sometimes collecting rent or trying to collect rent from a tenant can be a difficult proposition. You get calls at night for plumbing issues, and I saw a mouse.
That's always fun.
Those are the downsides of being a landlord. The upside of being a landlord is real estate appreciation, and historically, real estate has gone up in value, except in certain times there's only a few times in my career that real estate has really declined. But REITs provide you with a stabilized income stream, which is passive. So you make an investment and then the dividend is paid either monthly, quarterly, semi-annually, or annually from the REIT. That's why I like REITs. It's stabilized income. The stream is there consistently, and it may not be the highest yield, but it is a stabilized income stream.
Okay, I'll buy that. And there's a lot of different sectors of REITs. There's commercial property REITs, industrial REITs, senior housing REITs, medical facility REITs, cell tower REITs. If you can think of a class of real estate, you could probably name a REIT that goes along with it.
You're right. And also there's mortgage REITs.
Right. I neglected to mention them. And mortgage REITs fall under the REIT tax treatment, even though what they're not investing in are mortgages on properties, and they're doing derivatives, whatever. So they're really taking kind of advantage of that, but they've been some of the best performers over the past 10 years. While everyone else was expecting the economy to collapse and thereby take the REITs with them, these mortgage REITs, they performed quite well, didn't they?
Yeah, they sure did. There is quite a bit of risk in a mortgage REIT. I kind of avoid that category for a number of reasons, especially because of how they actually make their income. It's fairly complicated. It's something that I really don't have a lot of knowledge in. So as an investor, I try to avoid the categories that I don't have a lot of knowledge in. And I think those REITs, especially mortgage REITs, are risky, very risky.
Yeah, agreed. I mean, that's why I didn't buy them 10 years ago when they were yielding, some of them 15, 18%, like Annaly and the others. There's like 3 or 4 of them. They're kind of like difficult to analyze, not real transparent on their financial statements, at least from my limited knowledge of financial statements. They seemed a little opaque, but I could be corrected there. Hey, what about like, here's one that I think is pretty cool called the Cedar Realty Trust. And they invest in grocery anchored shopping centers and high density markets. 54 properties, 7.5 million square feet. You got to figure, regardless how bad things get, people still got to eat. And the strip malls anchored by supermarkets are some of the most stable commercial properties around, aren't they?
Yeah, they really are. And a REIT that has a diverse portfolio of properties, in other words, retail, maybe fast food, residential, apartments, industrial properties, is a REIT that you might want to really delve into deeper to figure out, how stable their income stream is. Specifically, retail REITs I would want to avoid, but stores, grocery stores, they're going to be there for as long as we need food. And I think we're going to need food forever.
Unless you can figure out how to grow it in a 800 square foot New York City condo, you got to go out to the, and we're talking more suburban here, obviously, but sure. In these urbanized areas, this is what you have to do. I mean, you have no choice. So they're going to be with us. Well, what about like these nursing home REITs? We talked about that. Some of them got pretty decent yields on them. Yeah.
And, as the baby boomers age, which we are, there's going to be a need.
You have to remind me of that, but thank
you. Yeah, there's going to be a continued need for that because, we don't get to live forever. So as the populations age, our families don't want to take care of us. Where are we going to go?
I agree. Hey, I could not agree with you more, but the concept of the REIT. So what you're doing is you're getting to diversify your real estate investments, not be an active manager of the property. Okay, so there's a benefit there, but then you're giving up a chunk of the profit, both to management and to overhead, because you have to have an infrastructure in place to manage multiple properties. It isn't always that easy to do, is it?
No, it's not. And, management of of property, and I managed real estate as well. It's a headache. And why not take a little bit less money in a dividend and let somebody else have that headache than rather the responsibility yourself?
I see your point. I think there's some validity to it. So what REITs are you personally investing in? And are you fully invested in the REIT sector, or do you have investments in other sectors as well?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita copper-gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I have a balanced portfolio. REITs, I sold some rental property that I owned, and I decided that I was going to develop a portfolio of REITs within that balanced portfolio to offset the loss of the income that I had from the selling the rental property. So I have a diverse portfolio of REITs. I have American Tower, I have Realty Income, I have net, which is triple net. So those are all different types of REITs. I have some industrial REITs, some warehouse REITs. So I would consider a diversified portfolio within the REITs. And I like them. They give a yield. You have to be kind of careful about REITs because they can fluctuate on a daily basis, and that kind of scares people when a stock drops $4 or $5 in one day. It's kind of, you have to have some guts to want to stay into the game for the long haul, but I'm in it for the long haul.
All right. Yeah, you don't want to be a total yield whore, if you will.
Exactly.
Because it could be dangerous, because there could be a reason why, if the yield is high, it means the price is low, relatively speaking, because the yield is based on the price of the REIT at the time. So there could be reasons why the price is bad. They know that major tenants are fleeing. They own property in Minneapolis, right? And everybody's leaving the place, or they're in New York, and all these office buildings, people are fleeing like rats in a tenement fire. All these things factor in, don't they?
They really do. And that's why it's important to look at the REIT. One of my goals is to look at REITs in a little bit of a different way. I want to tell the story of the REIT, why the REIT came into effect, why they buy the properties that they do, what's the philosophy of the management. Those are all things that most people don't look at when they buy a REIT. The first thing most people look at is the question is, what's the yield? What are they paying a dividend? And there's a lot more to investing in something than just looking at one aspect of it. I have kind of a little 6 points that I use. I look at how long the REIT has been in business. I look at how long they've paid a dividend, how long they've increased that dividend, what the increase of that dividend is, how diverse is their portfolio of properties, what sectors are they in. Like data storage is one that's, I think, is going to be a good area in the future. And then also what's trending. What are the trends like data storage? So those are kind of like the first categories that I look at, and then I delve into it a little bit further into the research and the background of the company itself.
Okay. And what are red flags? Tell us a few red flags. When you see this, you say, not for me.
Earnings. Earnings are the one thing that I watch very carefully. I also watch their vacancy factors. What percentage of their tenants are paying their rent? I could give you examples over the pandemic. Some of the REITs had tenants that weren't paying their rent at all. So you look at that and you say, okay, that's pretty scary. There is one REIT that went out to their tenants that was having a difficult time, and they said, look, we're going to defer your lease payments so that you can survive, but you're going to have to pay them over a period of time. So those are the things I kind of want to delve into and look at a company to see how stable it is.
Yeah, stability of earnings is everything, right?
It really is. And let's face it, real estate is based upon income, the income of a tenant, the income of a purchaser, and how solid that income is. So a REITs, that's why I like REITs, is because their income stream is typically pretty solid.
Predictable, except when you have a pandemic, and assuming the pandemic eventually ends, so they might have to cut deals with tenants to retain them, right? Other things, but eventually things will return, things will return back to some semblance of normalcy.
Yeah, I agree with you, Kerry. I think the pandemic has opened our eyes to realize that this virus isn't going to go away ever. I mean, it's just going to mutate into something else consistently. And we're not going to end up with never having a pandemic again. Who knows what's going to happen in the future? We need to look at how we can protect our future financial position today. When's the best time to start investing? Today.
That's for sure. And really, it's all about risk reward, right? So this is a relatively low risk area to invest in, but you got to do your research. You got to do your due diligence, because there are REITs that are just waiting to blow up. Now, over the past decade, maybe over the past 20 years, not very many REITs have gone under. I'd venture to say the number of banks that have gone under versus REITs is far greater. So you don't have a big industry risk, but company to company, your risk is going to vary.
That's correct. And you're spot on the stability of a REIT over a long period of time is pretty much guaranteed, although we have no guarantees in life. I think owning real estate is a good investment.
Yeah. Well, I would say we used to have death and taxes, and death is still there with us. But if you're in the bottom half of the population in terms of income, taxes, not so much.
I'd agree. And I mean, who pays the majority of the taxes in the U.S. anyway?
It's so true. It's so true. So as far as what you do, how do you help people who want to invest in REITs?
Well, actually, the goal is to start a podcast and a YouTube channel and go from there.
All right. Well, hey, we wish you the best of luck in your efforts. I think it's something that's needed. Just scanning through, doing Google searches, there's a lot of different information about REITs. And I like the sector with a couple of caveats. I think in a higher interest rate environment, which it appears that we're heading towards, could be issues, especially a lot of these REITs have gotten a free ride because rates have been so low, and the thirst for yield has led you to carefully examine the sector. That could all change pretty quickly if rates start going up rapidly. And I'm not saying that the Federal Reserve is going to do it or not do it. All I'm saying is something you need to be concerned about.
I agree. And if you look at interest rates have a cycle of about 30 years. So they go up for about 30 years and then they go down for about 30 years historically. And we're in a marketplace today where interest rates are obviously going to increase. And that will affect REITs. Historically, REITs have been hit initially with their valuations when interest rates do increase, but 6 months to a year after that, they usually stabilize. So I think maybe interest rates go up. There's probably opportunities to pick up some REITs.
Probably gonna lower their valuations because yield will have to go up to compete with everything else. Hey, my hindsight's 2020. I don't know what's going to happen. I'm the first to admit, but here, that's a likely scenario that if rates start going up, especially if they go up high, to try to quell inflation, could see a decline 10-20% in the sector. Hey, really appreciate you coming on, Brad. Just tell us where we find you. How do you connect with people on the web?
Right now is probably best through you, but I do have a website that is under construction right now, and it is yourfutureoffinanciallife.com.
Excellent. All right. And hey, if you've got a question for Brad, just shoot me an email, kl@kerrylutz.com. We'll get you an answer. Brad, been a pleasure. Very enlightening. Thanks so much for coming on. We'll talk to you again soon after your channels get up.
Thank you, Kerry, for having me. I appreciate it. Good luck.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.